Welcome to the Rodcast with Rod Turner, the show all about real estate. We discuss everything that affects asset-backed businesses, investments, and go deep into the details with some of the best in the business.
Hello everyone and welcome to another episode of the Rodcast. Today my guest is the investment manager and head of ESG at Olim Property, an FCA regulated commercial investment management company which manages over £1 billion of assets for pension funds, investment trusts and charities such as Oxford Colleges. She has over 18 years experience in commercial property investment with previous roles at JLL, the Salle Investment Manager and Acuitus as Commercial Investment Director. So welcome, Jo Seth-Smith. How are you?
Thank you, Ron. Very well, thank you.
So, Jo, I've given a very kind of brief intro there as to some of your previous roles. Do you want to just give the listeners a bit of background to you, how you got into property and real estate investment and how you ended up at Olim Property?
Well, it's going back uncomfortably quite a long time, Rod, but I actually, right at the beginning, I did a master's at City University in property valuation and law, and that really led on to me getting my job at Jones Lang LaSalle. So I was part of the graduate intake there, and I had, as part of that, to gear up to doing your APC, I had to do 2 years at JLL in various different departments. One of which was valuations, one was at Salle Investment Management, and I had a whole year in auctions too. So I spent about 7 years at JLL. I became an associate director there, and then in about 2010, our auction team left, and we created, I should say, with my 3 directors who founded Acuitus, which is a pure auction house for commercial property. And I was there for about 7 years. I became an auctioneer on the rostrum there. And it was in 2017 that I joined Olim.
Amazing. I never actually knew that Acuitus came from that was the story behind its kind of creation. So that's really interesting. So working at Acuitus, I imagine it was with more private clients than what you're currently doing now, which is much more with institutional clients. What would you say the main differences are in terms of institutions when they're looking for property investments and some of these private clients looking for property investments?
Well, in auctions you have to look at it on both the buy and the sell side. So I would say a lot of our clients were a mix between institutional funds, property companies and high net worth private investors. On the buy side, there was certainly more high net worth private investors and propcos than there were on the funds. And that's a lot to do with timing, really, because the thing about auctions is that once the catalogue comes out, nowadays live on the internet, whereas before it was much more, it landed on your desk in book format. There were only 3 weeks to do your due diligence, and so that sort of prevented a lot of the funds from being able to buy that way. I would say that private investors are, by their very nature, more nimble, and they have their own requirements about what it is they're trying to achieve from investing in commercial property. On the funds, you usually have a mandate, whether that's discretionary or not, and you are looking for a return, just as a private investor would be, but there's usually some sort of benchmark that you're looking at or referring back to. So a private investor, when you're dealing with, it is their own money. Of course, they are, in many cases, borrowing from a bank, but it is really down to them about what it is they are trying to buy, and that can be anything from a high street shop to an office, and again, why they're buying it. A lot of the time it can be for potentially a family trust or to create an income or for their own pensions. So that there are differences there about what you're looking at, but I would say that's across the board generally.
And in terms of, you made a really good point there, I think, on terms of auctions looking at not just the buy side but also the sell side. Why would institutional investors, what would make them go, right, okay, it's time to sell this asset? In your experience, what were the usual kind of typical reasons that they'd come to auction rather than going onto the open market?
From an institutional point of view, it's certainty of sale more than anything else, I would have thought. The benefit of selling through auction versus private treaty, and it doesn't really matter whether it's a fund or a private investor or a prop code doing that, is really about utilising the benefit of an auction contract. And the auction contract is non-negotiable. You have to do all your due diligence, legals, etc. up front. And then when the gavel goes down, that's it. It's an exchange of contracts straight away, and then you usually have something like 4 to 6 weeks to actually complete the deal. If you're selling by private treaty, then you usually have an agent representing someone on the other side, and you are negotiating the price and drawing up heads of terms. And in those heads of terms, the agreement can be subject to various things, usually subject to surveys and legal due diligence. So in one respect, it's almost a gentleman's handshake that you're saying, we're going to pay you this price, it is subject to X, Y, and Z, but we will do it by X date and then complete by X date. That is entirely different to auctions, where you're basically saying, actually, Mr. Auctioneer, I am going to go off and do all my work now, and then I'm going to compete openly with any other investor who is looking to acquire the same asset. I'm just going to pay you the best price on the day.
Yeah. And so now at Olim, give us an idea of what it is that you do there and what Olim focuses on in terms of the types of investments that they're making on behalf of clients, and how that differs depending on what the client's needs are.
Well, Olim has discretionary mandates for various clients, and the clients that we deal with may have different requirements about what they're looking to achieve from their portfolios, or the returns they're looking to achieve. And inevitably, that will impact our decision making about the type of assets we're buying, and the length of the lease term, and the covenant strength, and fundamentally the yield and the price that we're paying to acquire those assets. So our job really as investment managers is to find the stock, to acquire it, and to keep the costs at a minimum for our client, but inevitably to make the right decisions to achieve the best returns for them.
And when you say kind of discretionary, how much control then do you have? Is it all down to you, or do they give you a remit? Or when you talk about kind of benchmarks, is it an open discussion where they say, look, this is our benchmark, that's what kind of you're competing in, and that's how we're judging performance? Or does it completely vary depending on who the client is?
It does. It varies on who the client is and what they're looking to achieve. I would say what we do is, at the moment, we very much specialise on buying long, strong, indexed property. And that's actually something that will impact on the sectors that you're looking at, because, to give you a good example, retail, 15, 20 years ago was very much the sort of focus of institutions, high street retail, long leases to a W.H. Smith's or a Boots or an M&S, and we've all seen what's happened subsequently over the years. An institutional lease used to be sort of 15 years. Now you'd be very lucky to get a retailer signing up for 10 years without break in there. So it is different, and there was a significant rise from the institutional side of things of fund managers looking to the alternative sector. Now, alternatives is quite a broad
I always love
word.
why they call it alternative, because it makes up probably the majority now, I'd say, isn't it?
Well, I mean, there is still quite, effectively, you've got the core sectors, which
Yeah.
would be and remain retail, office, and industrial. And we've seen a significant rise in the alternatives, in inverted commas, which would be anything from, or anything outside of that area, effectively. But the benefit of the alternatives is that they do tend to offer assets with long leases, whether that's sort of 20 to 25 years plus, and then usually linked to RPI, CPI, or potentially fixed increases.
So would I be right in saying that the structure of a typical institutional property portfolio has changed then from retail almost being that fixed income element with long dated kind of income streams coming in, so much more kind of secure in what they're getting, whereas that now seems to be the alternatives have taken that position in terms of that portfolio. And then I know offices have always been quite cyclical. That seems to probably still be the case, doesn't it, at the moment? I mean, they're certainly not flavour of the month, depending on where you look.
No. Well, you're right. I mean, the makeup of a portfolio will inevitably change over a long period of time, and that is down to many factors, economics being one of them, and what's happening, outside of the sort of small commercial world that we reside in. And, retail, as we've mentioned, obviously, there were warning signs there before on the high street.
Yeah. And the way that the customers are behaving in terms of kind of, I don't know, the Amazon and e-commerce markets as well. And then other things happen to obviously turbocharge that, like COVID.
Yes, exactly. And industrial as well, very much in the same way. The industrial side was doing extremely well even before COVID. And then, of course, when you have people moving far more online, then distribution becomes a key part of that, and so it goes on. Offices, again, as a result, are struggling because there has been a structural change in that market, and people are working from home or flexibly working a lot more than they have, and that will have an impact on predominantly city centre offices.
And so where has your focus or Olim's focus kind of changed, I guess, in the last couple of years in terms of what the type of assets you're looking at to invest in? What would you say you're bullish on, and what would you say you're a bit more bearish on?
That's a hard question to answer because it does change. I mean, as I said before, we were always actually, I would say we were one of the forerunners in getting into alternatives from the start. So we have a huge amount of experience of investing in that side of the market. And actually, I think we sold our last high street retail unit just before COVID hit, which looked well timed. But we did, there was a bit of a hit on the value. But you just have to trust your instincts in times like that. I would say we still very much focus on the alternative side of things. But but it's not just that. You've got to consider the makeup of a particular portfolio. You'd be very short-sighted to just focus on a particular sector. You've got to consider diversification because you're mitigating risk for your client.
Absolutely, and I guess with your clients, they have a longer term outlook because of the type of clients they are, like pension funds and things like that. And so, again, when we talk about that makeup of a property portfolio, are they looking at, you've mentioned alternatives and the benefits of them now having these longer leases rather than things like retail, which used to, that now don't. Is that really what you're looking at in terms of maybe looking at their fixed income kind of aspects of that portfolio, because of they are an institutional investor, they have this long-term outlook, rather than, say, a private equity investor that might be looking at adding value, not needing income for the first X years, and then just needing to take everything at the back end, for example. And I guess, does that just dictate then what the types of things you're looking at, because alternatives are now fitting that bill at the moment at this point in time, but obviously that might change?
Yes, that's probably right. But again, it's not a straightforward answer. I mean, you do have to move with the market, and you'll find some funds that will be countercyclical, and then you'll find some who are, looking at different ways of creating a return for their clients. That can be in terms of having more of an active asset management role when they are looking, offices or multi-let industrials, for example. That what you want to try and do as a fund manager is obviously mitigate risks and costs for your client, and inevitably, if you've got a long lease to a strong covenant, then in all likelihood that rental income is going to continue to come in, and you're going to get inflation, as we've seen recently, moving the dial on those rental increases.
Absolutely.
If you have an open market review, then it's really down to what's happening in the market at that particular time, and you've got to get agents involved to represent. That's an extra cost, and it can take a lot of time for that to trickle through, and it's still a bit of an unknown.
And on that point then, how do transactions, or the level of transactions, affect the market that we're in terms of valuations? And what are you seeing happening now, and how does that maybe compare to other points in times where we've had kind of downturns in commercial property?
Yes, valuations, all funds will have valuations. Some of them will have monthly, some will quarterly, etc., etc. It is tricky for the valuers because they are very reliant on transactional evidence, and certainly over the last year or so that has pretty much been at an all-time low, or almost equivalent to where we were after the financial crash. That is obviously problematic, and I think this is where you have to take a view as an investment manager about when you decide to sell, because it may be that a fund manager will say, well, I'm not going to sell below valuation, but if that valuation is not artificially high, but it's high because there's a lack of transactional evidence, but from your experience and from speaking to the market on a daily basis that actually there is a limited pool of buyers out there, then that is going to impact on the value that you're going to achieve when you're openly marketing an asset.
And I guess from that point of view, are you then looking at, well, one of the things is, well, am I expecting this market to change? Because if this is just a short-term problem within my long-term outlook, then fine, I'll ride that storm and come out better for it the other side. And it must be incredibly difficult to make that call. I mean, what are some of the things you might look at in order to help you kind of judge those things?
Well, I think that's where experience comes into play more than anything else. A lot of people can revert to an Excel sheet and type in as many assumptions as they want, but as we have seen in the economy, you can't factor in a Truss administration, you can't factor in a war in the Ukraine, you can't factor in a number of things. You can try and forecast certain risks, but you sort of have to know from experience and from the feel of the market and from speaking to agents, as we do all the time, speaking to our competitors. I think that's equally important to really feel where the market is and where you think it's going. Now, look, inevitably, we're only human. We're never going to get it right 100% of the time. But that is, really what you pay your investment manager for them to have that experience, for them to make the judgment call.
And for hopefully getting more right.
Hopefully getting it more right than wrong, which we do.
Well, exactly. And you do, and that's seen in terms of kind of the performances against the benchmark, which Olim consistently have outperformed. And I guess from that point of view then, I've already asked what you think you're bullish on and bearish on. I know it's difficult to answer based on that, but if you go back to 2008, what was the effects of that on commercial property, and how long did it take to kind of come out in the market from the deciding factor happening in the market, and how long does that take to actually come to fruition on the streets, I guess, in terms of transactions and values, because we know property is a very slow-moving asset class. And I'd be interested to hear your thoughts on that.
It took, well, if we go back to the financial crash, it took a hell of a time, frankly, to come through, to filter through. And that is a lot to do with valuations. It's a lot to do with, the banks and getting administrators and receivers, etc., involved. But also for sellers and buyers to find the level that they're at. And there is usually a time delay in that particular issue. Sellers can have expectations. It's obviously harder for resi because it's, you're emotional about it. You can take a step back when you're talking about commercial. But buyers, particularly if you're looking at, high net worth, experienced property buyers, are going to pay you what they consider to be the appropriate value as at a particular date. And that, in a difficult market, is not always going to be where the seller's expectations are. And that is what takes the time. And that is when you get yields shifting quite substantially. And, going back to retail again, private investors tended to invest more in retail, high street retail, I should say, because they walk up and down their high street. They just know it. They know how many people go into that shop on their high street. Banks, there are a lot of sale and leaseback, particularly with the Barclays banks back in the day. And, private investors really clamoured to own that bank because they saw it as a absolutely sort of bulletproof investment. But as we have seen now, in hindsight, look what's happened to our banks. They are being, more and more removed from our high streets. And actually, the sort of types of properties that they physically occupied, it's what we would call in the industry fortress fronted, which is best way to describe it, a bit like an all bar one kind of thing. Not a lot of glass, not big windows. Funny enough, it was Santander who first started sort of going into that type of asset, but it makes the change of use tricky.
Yeah, interesting.
So, when you're buying something like that, you've got to think, well, what happens if that tenant is no longer there? Who else can I let it to? What is the alternative use for this asset? Because again, that's about mitigating risk going forward.
And I guess in kind of on that subject then, a lot of commercial property, especially kind of high streets, throughout, I don't know, the last 50 years has been almost based on, right, what do people want to do on a raining Saturday afternoon? And there's always been trends. I mean, we had kind of pubs and then we had coffee shops and now we've got, I don't know, this, in terms of leisure, it's probably this competitive kind of activities that seem to be coming out. Where do you see trends going in terms of the alternative market, not just kind of high streets, but kind of that whole alternative market?
I'm not sure I'm best placed to talk about the sort of occupier demand because it's not, it's not what we of course we focus on the occupiers, but we wouldn't necessarily go into, I don't know, people who are wanting to have pottery shops on the high street, for example, which, as a mother, I'm all for, because there's nothing like taking the little darlings to do some pottery of an afternoon. But as an investor, it's not something I would recommend for my client. It's down to looking at things outside of your world. So the cost of living crisis, for example. Back in the day, you could go to the cinema and it would cost you, I don't know, £5 a ticket. It was a relatively inexpensive way to spend time with your family. Now, it's incredibly expensive to do that, and cinemas have, paid the price for that, frankly, together with, actor strikes, etc., etc. So,
and is that down to then, I guess, like when we're looking at spending and household spending, you're probably looking at kind of what percentage of that is being spent on these staples of living. So housing will be one, transport, energy, food, clothing, and then you've got the discretionary budget, which is for your holidays and coffees and whatever in cinema and things like that. So, and as inflation happens and costs go up, and housing, which might have taken 30% of the household income, is now taking 40%, and energy, which might have been taking 10%, is now taking 12%. That all kind of ends up having to come from the discretionary budget. And when you've got households that are probably the lower kind of earners in an area, obviously they're more affected. So I guess if you're a commercial landlord and you've got your customer base is that market, then you might be thinking, right, I'm more at risk here than I am with the higher end market that has a bigger discretionary budget, and they might be going, right, okay, I'm instead of the Maldives this year, sorry kids, we're off to Butlins, or that kind of thing. So
yes.
I mean, is that the kind of analysis that those investors might be looking at in terms of trends, would you say? Or is it just actually, no, we just want to know that there's an existing kind of market for this already? Or would you be looking at, right, what's coming around the corner, and are we going to get into that? But I guess it's probably not your investors, your clients' kind of remit, is it?
No, it's not. It's not. But they're, same way that all of these things impact on the covenant strength of a tenant. So if you're looking at a pub, for example, when people were doing a lot more working from home, then the pubs in the countryside were booming off the back of that. Whereas, pubs in London, for example, were suffering because no one was coming into London anymore. But now we're seeing the London pubs doing particularly well because people are coming in. What used to be everyone out on a Friday night is probably now people out on a Wednesday or a Thursday night. It changes. You've got to be able to take the rough with the smooth. It's just about how long your view is on that. And actually, do you have confidence? Not just in the financials, because your financials one year may look great, but the next year they may not. You've really got to have a very good understanding of the people who are running the business, and whether they have got the skills to be making the right judgments. And the one thing about COVID is that we, and we've always taken the view, Olim, that we must have strong relationships with our tenants. But of course, when COVID hit, we were speaking to them extremely regularly. And it's not just about making sure that people are paying their rent, because you've also got to ensure longevity. It is a hard balance.
It's not just this year's numbers. It's what
you've
got
to take that. You've got to take that view. Yeah.
Fantastic. We're just going to take a quick break now and hear from our sponsors. Okay, so we've talked about kind of how you mentioned how yields have changed. In terms of, for example, industrial at the moment, that's almost been like the darling of property portfolio over the last few years, especially since COVID. And they were trading at some very, very low yields. Do you think that's sustainable for the future? I'm putting you on the spot a bit here.
Well, no, you asked me if we've hit the top of the market or not.
Well, I guess another way to put it is, are those? It's one thing to say, look, those yields are not going to be as low as they are, I don't know, from last year or from COVID. But is there still the demand? Because if rents are going up proportionally, and I don't know, someone signs a new lease and rents have gone up by 20%, then the capital value might remain the same, even if it's trading at, I can't do the maths in my head, but a 5% yield, for example. What are your thoughts on that? Do you think I'm right there, or am I missing something?
No, you're not missing something. And a lot of the reason those sorts of yields were paid for industrial was off the back of forecasted rental growth. But again, that is well. It's very easy to forecast something when you're plugging it into an Excel spreadsheet. And then you get to a point when, let's say, for example, you hit a bad economy and the tenants are going, well, actually, I've got more cards now, Mr. Landlord, than you used to. And actually, I want to have 2 years rent-free versus 1 year's rent-free to occupy your asset. And actually, there's a lot more industrial space out there than there was however many years ago, and I've now got a better pick. So again, it's not quite straightforward or black and white, because inevitably there's a big difference between what we would call a headline rent and a net effective rent. The net effective rent effectively takes account of things like rent freeze, the length of the lease term, etc., etc. And obviously, the more power you have as a tenant, the better able you are to negotiate. So I would say that industrial very much is still an area that people are looking to invest in. And actually, you've seen more private investors trying to get into that sector, which historically they have struggled to. But I think achieving those sorts of yields is going to be tricky going forward as a seller.
Yeah.
I think there is going to be opportunities for. The other thing to consider is that rates play an impact, because, of course, occupiers have to pay rates on top of their rent. And what we have seen historically is that the high street rates were extremely high. And that has had, as you have conceived, if you walk down any high street anywhere, that has had an impact, because not only was their rent high, but their rates were high. So occupationally, their costs were getting excessive. There has been a rates revaluation, and that has changed the levels. So industrial rates have very much gone up off the back of the rental growth that we have seen over the past few years.
So that's going to affect, obviously, what they can afford to be spending on their premises
and
costs.
When you have high energy costs, etc., then that will also have an impact. So again, probably not the black and white answer you wanted.
No, well, I wasn't expecting one, but no, it was interesting. I mean, what would you need to see happen to change your mind then, and to go, oh, actually, I am more bullish on industrial, and I do think that maybe they can get yields can improve further still?
Well, they can do. It depends on when you're buying and what you're buying, really. So it's if you're going to buy, if you're buying something in one area that looks undervalued, then you're going to make money if suddenly you can get a cracking tenant and you've got a good rent. It's going to be more problematic if it's vacant. If you bought something in the outskirts of London, industrial in the outskirts of London, when perhaps there isn't an awful lot of supply, then you could argue that was a safer bet, because even if it did become vacant, you're likely to be able to get another tenant in. And so, I don't think it's necessarily in terms of changing my mind of what would be right to invest in. It's just very much dependent on what you can acquire.
I guess it's more about the the asset class rather than the individual asset. If you think, right, okay, the industrial market, I'm going to take a good look at that and try and start pinpointing that, rather than looking at, I don't know, an individual. Because in any market, there's always going to be individual assets that have great opportunity versus others that might not have as good opportunity. But you might think, or when you're looking at any investment, are you thinking, actually, I'm purely looking at the asset on its own merits, rather than kind of focusing on where is the industry kind of going for, say, industrial or offices or things like that? Because would you look at a London office now, or would you just go, we're not really going to look at that, even though you might find one that's super cheap and what have you?
Well, I think, look, of course you keep an eye on a sector overall, but effectively what you're doing is you are investing in individual assets, and you are also looking at the makeup of your portfolio, and you've got to make sure that all of those things add up. So it's not so much chasing an asset class or a particular sector. You've got to balance out the whole thing.
Because I guess with valuations, it's going to be important as well, because it's based on, well, not just what your transaction is, but what the transactions in the rest of the market. And we've already kind of discussed how important that's been as well. So shifting a little bit to the other part of your role at Olim, which is head of ESG, how would you say that has changed over the past few years in terms of what Olim is looking at in terms of what's a good investment, and how does ESG factor into your decision making when looking at an asset?
It's certainly become, well, it's always been in the back of our mind, and we are particularly keen and have been very focused on making sure that our EPCs are up to the required standard, and that's to do with MEES, which is minimum energy efficiency standards. It is tricky in because policy changes and government changes,
and the way EPCs are calculated,
and the way
changes.
EPCs are calculated changes, and actually, software. There was a software update last year, which meant that an EPC that was potentially a B is suddenly now a D when there has been absolutely no change to the building makeup whatsoever, and that was done with no consultation with anyone, as far as I can tell. So that is problematic. But in terms of actually trying to make sure that we are doing the right thing for our clients, when we are acquiring property, we of course do due diligence in terms of the environmentals, and we are supportive of our tenants when it comes to putting things like solar panels, EV charging. We're not here to tell them how to run their business. I think that's the other thing. It is different commercial than residential, particularly when you've got a fully repairing and insuring lease, because of course, it is their property to do as they choose to do it. And this is the slight issue with MEES at the moment, because clearly no one has actually bothered to have a discussion with property owners, particularly commercial property owners, about who's about who can be responsible, or whether there is in fact a dialogue to be had with both tenant and landlord, because if it is your asset, i.e. I'm the landlord, I own the asset, but actually it's let on a long lease to a tenant, how do you make those changes?
Yeah, do you know what? I'd never even thought about that.
Well,
That's
clearly
really
no one in
point.
government has thought about that as well, so I wouldn't worry, you're not alone.
Please
there.
don't put me in the same boat as them.
No, you're not alone. But it has an impact on value.
Yeah.
Increasingly, it has an impact on value, because there's an enormous amount of cost involved to making these changes. And actually, if policy is murky, to say the least,
why would you
don't
put
want
the capital
to spend
in?
an enormous amount of your client's money unless absolutely necessary. Well, it's not unless absolutely. It is, of course, necessary in terms of you want your buildings to be sustainable, and that is important. But there is a balance, and you need to take account of what your tenants wanting to achieve.
I guess it goes hand in hand with returns, though, as well, because the whole idea of something being sustainable feeds into sustainable returns that you're getting. So it's more, if you can reduce a occupier's total kind of occupation costs of that building, so energy and utilities will come into play there as well. Like you just said, with business rates increasing in certain places, it goes into that whole pot that's allocated for their occupation. If that can reduce over time, then there's going to be a number at which the amount of capital you can spend to get that effective return that you can put in. So I guess from a financial point of view, it works in the same way, doesn't it?
Yeah, yes, it does. And it is very tricky for both the tenants and the landlords to be able to sort of put that as their priority at a particular time. Of course, when you've got a cost of living crisis, then tenants, and we found a lot of our tenants are looking to reduce their energy costs, of course, because we've seen what happened post Russia's invasion of Ukraine. We've all seen that, even from our own flats or houses. So when you're looking at sizable units, putting solar panels, for example, onto buildings is going to be a positive. But there is a huge cost implication to doing that in the first place. And what's tricky is that because it's a relatively new area and there are an awful lot of operators out there, whether that's solar panels or EV charging companies, you're starting from a relatively naive position, and you are to an extent learning how individual operators do things, and a lot of the time you're having to commit to quite a long-term arrangement or contract with these people, and you don't want to get it wrong. but it changes, and I know a lot of people wouldn't necessarily be aware that if you have, for example, an electric vehicle, you can't just plug that into any EV charging plug, which not a lot of people know. Sometimes only some EV chargers will take a specific make of car.
Yeah.
And it's not half an hour, it's an hour and a half. But you want to tick the box. And I would say that one of the slight issues we've got at the moment, because it does what we're trying to achieve in terms of sustainability and longevity for our clients' assets, is having a dialogue with the tenant. But they've also got, and you'll see it on any of their websites, how much importance they place on ESG. But actually, a lot of it is all talk, no pants, and actually trying to get them to provide you with information on what sort of energy levels they're using and that sort of thing. They don't want to give it to you. They don't want to share it with you. And that's understandable. It's their property insofar as they have that lease on it.
I think the mistake that we've come across sometimes is people associate energy performance with cost of energy. And that's not always the case. So like you say, sometimes you can improve your EPC, but your energy bills are still the same.
Mm-hmm.
And I think what I've seen, and I'd be interested to see if you've seen the same, over the last couple of years as the cost of living sort of crisis has increased, we've found that the emphasis has moved from ticking that box of showing you're sustainable to actually reducing energy bills, and that's become more of the priority. It's crazy that they don't align properly. It would be much easier for everyone if they did, but the reality is they don't at the moment. Is that what you're seeing as well over the last couple of years since cost of living's come in, or has it always been there?
To be honest with you, it is hard to analyse that. And there are a lot of companies out there who are being brought in to analyse exactly that thing. And it's that is the nitty-gritty of it. We are there effectively to protect our clients' interests, to make sure that we are having the appropriate conversations with our tenants. But it has to be also at the appropriate time, because you can, if you make the wrong decision, end up spending a lot of your clients' money and not getting the benefit that you would hope to get out of it. So rushing in just to tick a box is not always the right decision to make.
Absolutely. So what would you say at the moment the biggest risks to investing in real estate are, and what is it that you're doing to mitigate those?
Well, property is an illiquid asset, and that can be tricky in itself when you are working against sudden changes in the economy and the political landscape. But if I'm taking a particular date, sort of now, then you're going to be looking at the risk of the operational costs on our tenants and how that will affect their financial longevity or covenant strength going forward. You're looking at how minimum energy efficiency standards are going to affect the value of your property, because if you've got an EPC that's under a certain level, that is going to affect your value. And actually, the banks are becoming increasingly more conscious of that, and therefore that will affect what you're able to borrow. So there are all of those things. But as investment managers, it's again down to experience, it's down to stock selection, and it's down to engaging with our tenants and really understanding each and every property that we own for our clients, or that we manage for our clients.
Brilliant. So last question now, what do you know now that you wish you knew when you started in the property industry after you'd done that property and law degree and went into JLL? What is it that you know now that you wish you knew then?
That is a tricky question. I would say that it sounds obvious, but experience is everything. And I think when you first start out and you've done your degree and you've got the job, you just sort of sit there and think, well, if I know X, Y, Z, or I can calculate a net initial yield, I'll be all right. But I think it's also being conscious that whilst you can insert your figures into an Excel spreadsheet or create a model to look at risk, a lot of these things are based on assumptions, and you need to learn to take a step back sometimes from your inner world, and actually think about things yourself, back yourself. But that is based on experience. I wouldn't back myself on day one at JLL. You have to acknowledge that you are starting off from a very green position, but in time, things will become clearer and you will gain more and more. And actually, the lovely thing about working in auctions at the time was that I got experience in every sector, and in most lot sizes, not really above the £10 million mark in those days, because inherently your buyer base isn't going to be buying a 11 or £15 million asset from auction necessarily. It's happened once or twice, but it's not regular, and that was extremely useful for my learning at an early age. So I would say, absolutely, experience is everything, but always remember to take a step back, because one of my former colleagues used to say to me, look at that shop on the high street, and it could be the size of, I don't know, a paving stone, and the rent was £250,000. Now, just because the values are saying that's rack rented, which means, it's market rent, does that really look to you like that rent should be on that property? And if your head is basically saying, no, that seems absurd, it should be 25,000, when the market turns, it will be.
Yeah.
So that's the other thing. What the other thing I would say is, and I say this sort of for other women in property, is that my experience over the years is that you should learn to shout louder.
The squeaky wheel gets the oil.
Yes, absolutely.
Yeah, and do you know what? I think that's so true in terms of life in general, isn't it? And I'd certainly teach my daughters that, and they're very good at shouting loudly.
That's right. That's right. It's a great profession, commercial property, and it's so wide and so varied, and you get to meet so many extraordinary people in it. But I think, particularly as a woman, when you go and sit and have your bonus meeting or your salary review or whatever it is, we're very used to just sort of sitting there and thinking, well, if I work hard enough, it'll be recognised and I'll be remunerated appropriately, or I'll be promoted or whatever it is. And I would say that the issue that has been in the industry for the last 20 years is that has clearly not been the case, and it's obvious in the gender pay gap, which is hopefully closing now. But I think men seem or have historically been very good at saying, actually, I'm not happy about this, and I've been working ridiculous hours, and I have been loyal, and all of that, and they get paid when they scream about it. Whereas I find a lot of women, and I include myself very much in that, is that you tend to just nod and smile and be very, very grateful for the fact that you're employed and the fact that you're getting paid at all. And
why is that, do you think?
It's probably a little bit built into us from a very early age, and there's probably a little bit of intimidation about getting involved with a very male-dominated industry. But it is tricky, and you're always thinking that you don't necessarily want to rock the boat, and you don't want to be seen as someone who is argumentative or dissatisfied, because you're just forever hopeful that you will be recognised in the end. This isn't, by the way, my experience across the board, but I have been very lucky to work with some extraordinary women, and I would say that is something that is discussed most.
That is excellent advice. So I know we've got a lot of female listeners, and we do tend to try and get a lot of female people onto the podcast, but it is definitely male orientated when it comes to looking at like who our guests have been. So thank you so much for that.
Welcome.
The thing I'll take away as well in terms of kind of advice for people maybe newer into the industry, is getting that experience under your belt in terms of kind of buy side and sell side. And it sounds like the auctions were a fantastic way to do that for you, and also valuations as well. So it sounds like that was a really kind of great stepping stone, and I think people can get a lot of experience through those kind of things. So yeah.
Yes, it's a shame that we don't have auction rooms anymore, is the only thing I would say, because there was an enormous benefit of getting everybody in a physical auction room and meeting and having discussions with people on both sides of the fence. It's obviously all mostly online now.
And I guess the benefits of being online are collecting data and seeing kind of like who's registered to bid on something and that kind of stuff. But those benefits obviously take away the benefits that you're talking about understanding as well a bit about the psychology of how people buy and sell as well.
Which obviously has an impact on value.
Yeah.
So, yes, you're right. And you know, we're forever trying to push the auction houses to get back into the room. And I'll continue to bang that drum. You're right. There is, you know, it's a very transparent market, auctions, and there is something, particularly in a difficult market, I think you can lose out by not necessarily having the option of being in an auction room. When everything is going well and you have a lot of registered bidders, is a lot more transparent for the seller, because you know how many people are actually going to bid on your lot. And in a good market, they will probably all bid on your lot. But you can get a lot of people in a bad market or a difficult market registering to bid on your property, but not bidding.
Yeah.
And so what seems like a guaranteed sale isn't. And then you very much are reliant on the auctioneers doing their job, which is actually having proper discussions with potential buyers and then being able to advise you on whether or not that property is going to sell or where your reserve needs to be.
Yeah, exactly. Whether you need to reduce your reserve to entice them in, or maybe withdraw it and look at a different method. Yeah.
But I would, you know, as a someone young trying to get into the industry, it's a really, really great way of getting experience in every sector. So I highly recommend it.
Brilliant. Well, thank you very much for joining us, and hopefully we can have you back on the show again.
That'd be my pleasure.
Brilliant.
Thank you.